We've discussed this several times on this channel. The fundamental dynamics around crypto have completely changed because now it's not retail anymore that's driving the prices, it's Wall Street. It's purchases through the ETFs, it's purchases through the Bitcoin treasury companies. And because of that change, it's unclear whether or not the models that used to work in the past still continue to work in the future. For example, this here. This is the Pi cycle top indicator. It's an indicator that uses two moving averages where the ratio of 350 to 111 is a number that's very close to pi. That's why it's called the Pi top indicator. And this was actually an indicator that was created retrospectively. As in, the creator had this kind of data and looked at what point in time did Bitcoin top in the past, and was always when the orange line, so the faster of the moving averages, crossed the slower of the moving averages. So that's the data that was available at the time. Now what's so interesting about it is that it still worked extremely well for the following cycle top. So this was completely a prediction over here in 2021. Close to just a few days, the model figured out that 63K was a potential top in Bitcoin. Yes, we saw a secondary rally again, and that superseded the heights of April of that year. But interestingly enough, during that secondary rally from 30K all the way to 69K, that was all institutional demand. So we saw the very large whale wallets accumulating at that time. It was not the number of retail investors, it was not the number of transactions that went up. And so that's a potentially cautionary tale, because right now the price is going up again because of institutional demand, not because of retail. And so the Pi cycle top indicator is very far away from signaling any kind of bull market top. But again, it might fail in the future, because this is the situation right now. This is the number of Bitcoin addresses that have at least one BTC. The chart looks pretty much the same for 0.1 BTC or 0.01 BTC. It's the same. When we take away the Bitcoin price, we just look at the number of those wallets. The accumulation has stopped. Retail isn't buying. Retail is rather selling. Retail tends to only buy in when Bitcoin has already dropped quite a bit. It seems like the retail investor got a bit smarter and is now buying mainly on price corrections. And so what's so interesting about this development is that while the number of wallets is now at very similar levels to March of 2023, the Bitcoin price went from 22K to above 100K. So it's 100% driven by institutions. The big question is, will Michael Saylor, will the Bitcoin treasury companies, and will Wall Street via the ETFs continue to accumulate at this pace? Because they've already caused the 4 to 5x rally in the price, and they might push the price even higher. What I find so fascinating about this accumulation is that it seems to not slow down, because what we see over here, that's the balance of Bitcoin. This looks like a linear line, but the price of course went up by 4x. In other words, for this accumulation to stay at this linear constant pace, the US dollars that have flown into those instruments also must have 4x'd during the time. And so, of course, the higher the Bitcoin price goes, the more capital it needs for the Bitcoin accumulation to stay at that pace. It's very interesting whether or not this will continue, and if yes, for how long. The market is clearly maturing. What we see over here is the 60-day cumulative increase of the Bitcoin price. So how much did Bitcoin go up in the last 60 days? And it seems like, since the market cap of Bitcoin is now much larger than it used to be a few years ago, that the percentage changes also come down. We can just optically draw a line through that. The rallies and the price appreciation is simply less dramatic now, and we should expect this to continue. Now, the majority of Bitcoin is not yet held by the ETFs and by Michael Saylor, etc. Most Bitcoin is still held in self-custody or by the centralized exchanges. Thus, I do believe it still makes sense to look at what are the dormant Bitcoin doing. What are the Bitcoin doing that usually do not not move. When the Bitcoin that tends to just lay around suddenly gets moved, that's a potential indication that the Bitcoin gets sold and that the long-term holders are selling. The diamond hands suddenly become paper hands. And this indicator shows when this happens. This is the median value of coin days destroyed, MVOCD. And it tended to be very close to the price when we peaked in a cycle. It once hit at 70k, it once again hit at 100k, then recently again. And so I think it's a nice approach to at least take partial profit if you are, of course, over allocated to Bitcoin. It's all about being properly balanced across asset classes, not just owning crypto, but potentially also owning things like property or precious metals. Here's a slightly different way to look at this. This is the value days destroyed. So now we don't look at the median, but we just look at the raw number of Bitcoin times the US dollars. And it peaks when the long-term holders are selling. And I use this as a selling signal as well. Whenever the very serious investors in Bitcoin exit the market, I might consider exiting partially as well. The next few weeks will be very interesting for Bitcoin because we are now at the crossroads. We've talked about the resistance of 111, 112k regularly on this channel. It's a historic milestone if you can get above that resistance. Again, this is the Bitcoin long-term price chart. And this is just a curved line. There's nothing mathematical about this. But interestingly enough, even when we zoom in, that line touches those cycle tops extremely well. Just have a look at this, right? We are always getting extremely close to the line and then we turn around. And we are again at that resistance, and the resistance now has increased slightly. We are now at 112.5k. But yeah, that's the potential problem, right? The question is, will the long-term holders sell again once we get close to 112k? My impression is that they probably won't, because the people that wanted to take profit at 111k have already done so. And if Michael Saylor and if the ETFs continue to buy, we will at some point break this. And then the diminishing returns might not be that diminishing as this line suggests. Yes, of course, in the early days, Bitcoin rose faster than it does today, but it might not flatten out that heavily. And so the game is always about risk to reward. And the question is, how much potential risk is there in Bitcoin? Let's say things suddenly turn around. Let's say there's a black swan event. Let's say a centralized exchange out of the blue suddenly blows up. What could happen in the worst case? Because nobody knows the future for sure, right? We always just work with probabilities. What we've got over here is my favorite bottom indicator. It's the CVDD, the cumulative value days destroyed. And the reason why I like this indicator so much is it's monotonically increasing. It never goes down. It shows us the absolute bottom. At least historically, it showed us the absolute bottom for Bitcoin. Bitcoin never went below that CVDD in any significant manner. And currently the value is at 40k. Now, I'm not saying that we will hit 40k anytime soon. I'm just saying that in the worst case, we could approach this line again if something suddenly out of the blue blows up. Because that's fundamentally the nature of crypto, right? It comes in cycles as the price increases and continues to go up, and everybody agrees that positive times are ahead. There are more and more people that enter the market with leverage. And leverage is always additional risk. Risk tends to build up during a bull market, and at some point it might de-lever again. In a way, we could see the implosion of the Terra Luna protocol, right, which started the last bear market. We could see this just as another deleveraging event because the protocol promised 20% APY, and they simply just assumed that the protocol will grow by that rate, that enough money flows in with at least 20% per annum. That's not what happened, right? The market stayed still for a while, and then this inherent leverage just got delevered. The whole protocol imploded. Now, I'm not saying what the next Terra Luna will be. I'm just saying that the longer a bull market continues, the more leverage tends to build up. And if the capital that gets into the system doesn't grow at the same rate as the leverage, risk increases and volatility can lead to violent deleveraging events. And again, if that happens, the floor might be at around 40k. Of course, that's now still increasing. This is monotonically going up. Well, we started this video though with the idea that a lot of models that might have worked in the past could potentially break in the future because the overall structure has changed. It's not anymore the retail investor that's dominating price discovery, it's now Wall Street. And while this indicator worked extremely well in the past, there were similar indicators that worked very well in the past. For example, this is the 200-week moving average. The Bitcoin price was always above that moving average historically. And in the year 2022, you might have assumed that the absolute bottom for Bitcoin is at $22,000, right? This is where the 200-week moving average was at the time. But then things got worse and FTX blew up and we suddenly saw a bottom in $16,000. So those models don't have to work perfectly. They simply just give us a range at what point things can be cheap. And so we have to trade the CVDD in a similar fashion. Just because we fall below that line doesn't mean that crypto is doomed to fail and can never recover. Right? It does take quite a bit of courage to buy at those kinds of levels below the moving average when we never fell below that line in the past. But at the time, it was the best time to buy, obviously. Everybody that bought at 15, 16K subsequently made a 7 to 8x return. And so fundamentally, here's how I approach this market. I want to be diversified, but not just because of the uncertainty of what's going to happen. It's also to be prepared in case of a crash. I want to have money on the sidelines that's not correlated to crypto, that for the case we see a crash, and it's just a matter of time, right? It might happen in a month, it might happen in 3 or 4 years. Just in that case, I'm able to pick up the pieces. I'm able to buy the bottom. Now, no mathematical model is perfect, but some are useful, and especially in combination, they become extremely useful. What we've got over here is the CBBI on cointalkscrypto.com. It's an aggregate indicator and it shows us very nicely historically when Bitcoin was extremely cheap or extremely expensive. Now, currently we are rather on the expensive side, so it does make sense to be diversified. But just because we are at 77 out of 100 in this indicator, it does not mean that we should sell everything, because have a look at the past. If you sold at a value of 77 in October of 2017, you would have still missed out on another 4x in Bitcoin. Bitcoin went from 5,000 all the way to 20,000. So really, this indicator just gives us a range. And when we are at these extreme levels, of course, it does make sense to offload heavily. Now that's for the top, but the same is true for the bottom. When we are at extreme low levels, we want to get into crypto heavily. But this does tell us that at some point, something might blow up. We could see another 2 or 3x in Bitcoin. And of course, we do want to ride that performance, but we don't want to ride this irresponsibly. We don't want to be 100% exposed. Now, the mistake I see many people make is they diversify away from Bitcoin by buying other risk-on assets. They buy maybe other altcoins, they buy maybe technology stocks like Tesla and Nvidia, and they think they're diversified. But the problem is the market becomes more and more correlated because now Bitcoin is also held by Wall Street. So if Wall Street gets spooked, if Wall Street wants to reduce volatility, they are going to sell the tech stocks at the same time as they're going to sell Bitcoin. So the correlation increases, things move more in the same direction at the same time. And so if you want to hedge our Bitcoin exposure, I believe that the best asset class now is precious metals. It's definitely not stocks. Have a look at this. This is the S&P 500 relative to gold. This is a very long-term chart. It starts in 1884. So this is 150 years of data or so. And the volatility is massive. From bottom to top over here, this is an outperformance of stocks of more than 1000%. And this crash of the S&P 500 relative to gold was more than 90%. So had you bought gold instead of stocks in the 1970s, you would have made 10 times more money compared to being in stocks. So those waves, they do matter. And in the grand scheme of things, this looks rather expensive to me, the stock market. The gold market is cheap relative to stocks. Or have a look at this. This is Bitcoin relative to gold. And I'm not saying that this resistance line here will stay forever, but I still find that's quite interesting. For more than 4 years, we have not seen Bitcoin outperform gold. So Bitcoin and gold gained the same percentage returns during that time. And so, of course, we rather want to be in gold at this point, and we rather want to be in Bitcoin at this point. But again, I believe that the CBBI is a better metric than just looking at the ratio of gold to Bitcoin. Still, diversification makes sense. When you've got some uncorrelated assets on the sidelines, and you can then deploy this into BTC when it subsequently makes multiple X returns, it's a very good feeling. On top of that, of course, overall portfolio volatility also goes down. It doesn't feel that bad anymore. We become somewhat agnostic to the price dumps in crypto, because if things are going down, that's fine. We potentially get an opportunity to buy low again. Now, within crypto, the decentralized finance sector looks quite interesting, because across all blockchains, we are not yet at all-time highs in terms of total value locked, in terms of capital that's floating around. Asset prices in decentralized finance were way higher at the end of 2021. Then we had the Terra Luna collapse and the subsequent bear market, and now since October of 2023, the recovery. But we are still quite far away from the all-time high. Yet when we look at the number of stable coins that are now floating around, that is at an all-time high. In other words, there seems to be less inherent leverage in the system. So I do not expect a major protocol blowing up tomorrow. But it is important to watch both metrics, the TVL in DeFi, but also whether or not money is flowing into the space, right? This is what stablecoins are all about. So we are a little bit in no man's land here, right? It's a bit of a gray zone. We are not extremely cheap historically, but we aren't that heated either that everything is going to blow up tomorrow. The way how I navigate this is using the very badly performing altcoins. And I am not buying the altcoins. I'm doing the exact opposite. What we see here are the smaller altcoins with their performance in the last year. And just have a look at this, right? Bitcoin in the last year went up, but all of those altcoins, not all, but most of them went down. And so I'm betting on falling altcoin prices. I'm also hedging that versus the general macro. As in, if now Bitcoin and Solana and Ethereum was to suddenly go up, then my short positions in the altcoins wouldn't be affected by this, because the relative performance of those bad altcoins to those major players matters. What we're seeing over here is my perpetual futures account with the current positions that I've opened together with the hedges. So it's expected that the hedges go in the opposite direction to the altcoin shorts. I've started the account with 40K 2 months ago. Now there's been more than 25% return already. I forgot to set a proper stop loss over here. That's why this went down more than I wanted to. Without that massive drop, the line would look much nicer and it would have been even more return. But 10%, more than 10% per month is more than enough for me. And so this is then how that works, right? We're just betting on poorly performing altcoins to continue to do bad. And this underperformance happens very constantly with very little volatility. And we can just flip this chart around, right? When we bet on falling prices, then it looks like this. Would you buy an asset like this? Would you buy something that continuously appreciates? Now this is a linear scale. On a logarithmic scale, it looks like this. Still, right? Very constant long-term growth under comparatively little volatility. So the chart isn't going up and down erratically that much. And I think this is really where the alpha, where the outperformance in crypto lies. It's not about finding the 1 or 2 altcoins that do a bit better. It's about exploiting the market structure. Now, why do we see so much red over here? Why do we see so many altcoins underperform that consistently? The answer is token unlocks. It's new tokens that hit the market and the demand not catching up to that growing supply. So this supply schedule here belongs to this asset. Every single week, there are hundreds of millions of dollars of unlocks in crypto. If money doesn't flow into the space at that rate, we see this kind of performance long term. Here are the tokens with most issuance in the next month. So for example here, right, Altcoin is a token with a ton of additional supply hitting the market. And I shorted Altcoin on May 23rd when we had a short squeeze and a very nice potential entry opportunity. So I shared that trade in the premium membership, that's thebitcoinstrategy.com. And then just a few days later, I closed the position. And yeah, if you've got proper risk management in place, you can make very nice returns. The community, of course, copy traded that as well. And so members got similar kinds of returns. But really, fundamentally, premium is not just about copy trading whatever I do. It's more about learning. It's more about exchanging information with the rest of the community and leveling up together. We want to take advantage of the market structure. We don't just want to blindly copy trade others. And so there are plenty of trades that I did not do, but that the community still benefited from. Crypto is a game of both luck, but also of skill. And the more we play the game, the less important the luck component becomes, and the more important the edge, the skill becomes. It's pretty much like in a casino, right? The casino does not know the outcome of a single game, but when the odds are in our favor, if we play often enough, we win. I mean, from the perspective of the casino, of course. And so I've published several tutorial videos on how to set this all up. How do we bet on relative evaluations, and how do we do this on Hyperliquid, which is the leading platform for perpetual futures in decentralized finance right now. And here, this video is probably even more important. How do we do proper risk management with that? Because while those trades look impressive, it's all about the long term. Most trades make money when we follow that strategy, but some don't. And we don't want to blow our entire portfolio just because of a single short squeeze. So yeah, feel free to check it out. It's currently $125 per month. If you've got a larger portfolio and you want to get feedback directly from me, you want to have a one-on-one session, you can also sign up for the yearly membership. For the yearly membership, you do get $250 off, so it's cheaper per month, but also there's a 1-hour Zoom call included. So I simply want to welcome everybody that makes a longer term commitment. And of course, we can talk also about other asset classes, not just crypto, how we are properly diversified across stocks, precious metals, property, etc. A link to premium should pop up directly over here. Just click on that link. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.